All right, welcome to The Explainer. Today we're diving into the latest financial report from Japan's Ateam Holdings, and, well, right off the bat, we've got a fascinating puzzle on our hands.
So when you first look at their Q1 report for the 2026 fiscal year, you might have to scratch your head a little bit. Because, you see, their sales actually went down.
But get this, their net profit absolutely skyrocketed. We're talking a massive 128% jump. So what gives? How on earth does that happen? Let's unpack the real story behind these numbers.
Okay, first things first. Let's just put those big headline numbers right next to each other. It's really the best way to see this paradox in action. And there it is, clear as day. On one hand, you've got net sales dipping just a little, down about 2.6%. But on the other, wow, net profit is up over 128%. That's not just a small bump, that's a huge leap.
So the report itself actually gives us our first big clue to solving this mystery. It says right there that a big chunk of this profit came from a special gain. And what that means in plain English is they sold something. A big piece of the company, in fact.
Okay, so if that huge profit number is mostly from a one-time sale, it makes you wonder, right? How's the actual day-to-day business doing? To figure that out, we've got to look under the hood at their three main business segments. And this breakdown really tells the story of their business. You can see Media Solutions is the big one here. It's the engine of the company, pulling in a massive 71% of all their revenue. The other two, Entertainment and D2C, are much smaller pieces of the pie. Now, what's happening in this huge Media Solutions segment is really interesting. They're basically going through a strategic slim down. Think of it like this. They've made a conscious choice to pull back on ad spending. They're prioritizing making more profit on each sale, even if it means making fewer sales overall. And boom, this chart shows that strategy is working exactly as planned. Look at that. Sales are down a bit, by about 5.7%, but their profit from this segment is up almost 35%. That is a fantastic trade-off in their favor.
Now, switching gears, we have their direct-to-consumer, or D2C segment. This part of the business is a completely different story. It's not about slimming down. It's all about growth, and it's being supercharged by their hot cosmetics brand, Lujo.
And you can see that growth right here in the numbers. Sales are just surging, up more than 26% compared to the same time last year. And profit is looking healthy too, up almost 12%, a real star performer in their lineup.
And then we have our third piece, the entertainment segment. This is their mobile gaming division, and, well, it's having a tougher time. It's facing some pretty strong headwinds right now, and that's hitting both revenue and profits.
Yeah, the numbers here don't lie. It's a tough spot for them right now. Sales are down, and profits took an even bigger hit, shrinking by nearly 31% this quarter. So when you put all this together, the slim down in one area, the growth in another, and the struggles in a third, it's clear this isn't random. These numbers are the direct result of some really big strategic decisions the company's making about its future.
So let's circle back to that big sale. Why'd they sell off their Ateam Financial subsidiary? Well, it came down to simple economics. The market was getting super competitive, which meant it was costing them more and more money just to get a new customer in the door. It was becoming a real battle to make a profit, so they decided to get out and focus their energy elsewhere.
And that one move, that sale, pumped 153 million yen straight into their profits. And that right there is the biggest piece of the puzzle. It explains a huge chunk of that wild 128% profit jump we saw right at the beginning. But here's where the story gets even more interesting. This wasn't just about cutting things back, because while they were selling off one part of the business, they turned around and made a big purchase. They bought a company called Signity Inc. Now, Signity has this really cool patented technology for push notifications. You can probably see the strategy here, right? They just got out of a business because customer acquisition costs were too high, and now they're buying a tool that helps lower those very costs. They can use this across the entire company. It's a tool that creates synergy between all their different parts. And this wasn't a small bet either. They put down over 1 billion yen for this acquisition. That's a serious investment in this new strategy.
So you've got this sale, this big acquisition, and all these shifts in their core business. What does this all mean for the rest of the year? What's their prediction?
Well, this is where it gets kind of counterintuitive. Even with that huge Q1 profit, they're actually forecasting that their net profit for the entire year will be down. A lot, actually. Over 40%. And why? Because that big 153 million yen gain from the sale was a one-time thing. You can't sell the same company twice, right? So that temporary boost won't be there in the other quarters.
So when you step back, Ateam is making a huge bet. They're trimming the fat, getting rid of parts of the business that were too costly, and doubling down on a leaner, more focused strategy with new tools to help them grow. But the big question remains, will it work? Are these the right moves to create real, long-term, sustainable growth? We'll have to wait and see.